Well, good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Coming up on the show today, Alan Small, Senior Investment Advisor at the Alan Small Financial Group with IA Private Wealth, is our guest co-host, and our featured guest today is author David Thomas. He's here with his new book, The Fairfax Way. And we want to hear from you this morning on First Call. You can reach us with your questions on North American large caps, and we'll have Alan answer as many of those questions as you can. Remember to call 1-855-326-6266. We will open the phone lines in about 30 minutes. And our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you here in the BNN Bloomberg newsroom. Prime Minister Mark Carney won a narrow vote to pass the Liberal fiscal budget last night. The minority government got 2 votes that put them in the majority, mostly from abstained votes and support from Green Party leader Elizabeth May. Carney promised May the Liberals would abide by the Paris Agreement target on carbon emissions to get her backing. The new budget looks to put tens of billions of dollars in trade, infrastructure, defense, and housing to work. MTY Food is reviewing its options, including a potential sale. The Montreal-based company launched a review process and hired financial advisors to explore financial alternatives, including a partial or entire sale of the company. MTY says there is no assurance a transaction will occur. The company is home to restaurant chains like Cold Stone Creamery, Wetzel's Pretzels, and Mr. Sub. Shares of Barrick Mining are rising in the pre-market. The Financial Times is reporting that Elliott Management has built a stake in the company valued at least $700 million US. Elliott is an American hedge fund and activist investor that typically forces major changes at companies. Barrick has struggled to benefit from the gold rally, largely due to issues at some of its international assets. And now our top-line story. Shares of Home Depot are falling in the pre-market. The world's largest home improvement retailer cut its full-year earnings guidance. The company says ongoing consumer uncertainty and continued pressure on housing are impacting demand. Home Depot also reported lower-than-expected profit and sales, citing a lack of storms that hampered demand in roofing, generators, and other categories. Home Depot's bleak forecast provides another warning about the strength of U.S. consumers in the absence of official economic data during the U.S. government shutdown. Let's bring in our guest host now. Alan Small, Senior Investment Advisor at the Alan Small Financial Group with IA Private Wealth. Alan, thanks as always for joining us.
Great to be here.
Are you doing any renos right now?
Not many. But it's funny, when they say that a lack of storms.
It's an interesting dynamic, isn't it?
I guess they're waiting for storms to meet their numbers. I don't know, but it does tell you a lot about the consumer. Obviously, we're going to get some earnings from Walmart and Target and some of the big names. But obviously, different type of retailer. Home Depot is affected by interest rates, housing prices. All that goes into what is happening over there. Same-store sales are down. I guess people just aren't, fixing up their house these days, and a lot of it's due to uncertainty. A lot of it's due to, not knowing what's going on in the economy. The tariffs play a part, higher costs for the company. All that is playing a big picture, painting the picture over at Home Depot.
Well, and there's been so much talk about the K, right? We've seen the rich getting richer and everybody else kind of going down this way. Will this kind of, is this going to increase fears, especially if we start seeing like Walmart's reports and they're not as good as expected? What happens with that? Yeah,
well, a good question. And I think all that will play a part, especially when we have a lack of economic data coming out of the U.S., right? Government's been shut down for a while. It's now reopened. We're going to get our first data points, I believe, this Thursday. In a couple of days, we're going to get jobs reports. So that's going to help. We're probably not going to see in October or any numbers from October. And then we're going to go right to November, I guess, in the coming weeks. So a lack of data, I should say, these types of reports make a big difference. Reports from the banks, the big banks in the U.S. That also is going to has made a big difference. So these are, I guess, the glimpses that we can get as to how the economy is faring in the U.S. What the Fed may do may depend on a lot of this commentary. Is the economy strong? What are we going to hear with jobs coming up? Even though it's going to be a September number, it's still going to go a long way. Perhaps the Fed, right now, it looks like less than 50% that they will cut interest rates. perhaps that number starts to tick higher when we start to get some numbers out of these big retailers.
Yeah, that's driving it a bit. One company I want to ask about, if it'll have an impact or not. They're reporting this week, Williams-Sonoma, which is not your average company, like shopper, probably average shoppers necessarily going there, a little more high end, if I'm not mistaken. What would that tell us anything about the market as well, if their numbers are off too?
Well, it's interesting. You mentioned the K-shaped recovery, right? Yeah. So on the high end type of companies, type of retailers, we don't see as much of a decline usually as some of the middle of the road type of names. So it'll just tell me that the K-shaped economy is alive and well. If we do start to see some of the high end retailers doing just fine, whereas the not the smaller, but the more middle of the road type retailers, the Walmarts, the Targets, if they start to struggle, whereas the high end is doing just fine, that will tell us a lot as to what's going on in the economy today.
Still kind of worrisome though. You want a healthy.
You'd like a healthy, absolutely. You want to hear, absolutely. You want to hear that, interest rates coming down to help the economy. Taking it one step further, I'd love to see interest rates come down here in our country as well. Although we're hearing that the Bank of Canada could be on hold at the next meeting as well. So I'd like to see interest rates coming down. I'd like to see economies do what they can to make the environment good for business. And right now, both in Canada and the U.S., businesses are struggling with the weight of higher costs due to tariffs and things like that. And that's creating the uncertainty, and we're seeing it play out in these companies' earnings. And
what would it take then to see to drive towards a rate cut? Because we dropped down to 50%. I think at one point we're up at 85% for the next rate cut, but we're down to, as you mentioned, 50. What would it take, do you think?
I think you're going to have to see our jobs number coming out in the U.S. on Thursday. I think a weak number there. You're going to have to see perhaps weaker data coming out from these big retailers. It's going to be tough. I know the Fed has talked about inflation. Inflation's over 3%. Their target's 2%, so 50% above what they want to see. So are they focusing on inflation? Are they focusing on jobs? Either way, I think there's going to be a few people dissenting when they come out with their decision. We'll just have to see what happens. But overall, right now, as you said, it looks like it's a toss-up, 50-50 toss-up, whether they cut or not.
And then one other earnings that I know it's coming out Wednesday after the market's closed, NVIDIA. How much will that shape everything?
NVIDIA is huge. Right now, what we're seeing in the markets, a decline in the markets, is all about tech, all about tech spend. Is the spending out of control? Borrowing, is that starting to become a little worry? So NVIDIA earnings, key for this market, probably the number one thing.
And we're going to talk more about that coming up in just a bit. But we'll leave it on that note there. But up next, we'll take a look at the markets before the bell. See how things are shaping up on the markets. We'll start with the U.S. futures, and concerns over AI and tech valuations, along with hopes fading for a federal rate cut, have them trending down again. You can see the Dow is off by 0.75%, the NASDAQ 100, 0.53%, and the S&P 500 off by 0.45 right now. Over in Asia, rough day there. Look at the Nikkei off by 3.22%. Tech sell-off being felt there, along with weak Chinese data and tensions between China and Japan. The Hang Seng off by 1.72%, and the CSI 300, best of the bunch. That's not saying a lot right now. It was off by 0.65%. And heading to Europe, it is a down day there as well. Look at how similar those numbers are right now. And the FTSE 100 off by 1.44%, the CAC 40 off by 1.46%, and the DAX off by 1.49%. So, sell-off days. As for the TSX, where did it finish yesterday? It was down by 0.83%. Mining, tech, and real estate made for the down day, somewhat offset by energy. Taking a look at some of the movers, the winners and losers. Superior Plus up by 5.72%. Perpetua Resources up by 4.92%. Aya Gold and Silver off by 5.25%, and Stantec down by 6.2% almost. Turning to the metals now, let's see how they are doing. Gold is hovering closer to that $4,000 mark again. It's off by 0.79%. Silver back down below 50. It's off by 1.51, and copper down by a half a percentage point. And looking at oil, and you can see that Western Canadian Select, it's down. There's concerns over supply and weak demand. It was off by 2.52%. And south of the border, looking at the crude down there, you can see WTI still at around 60. And right now, it's bounced back a little bit. It's up by 0.28%, back over the $60 mark. I want to bring in Bitcoin prices, crypto prices. They are paying the price for market volatility. Bitcoin is down more than 25% since its October highs. It's down around 91,000 and dropping again. And Ethereum is off more than 5% in the last 24 hours. So a rough ride for the cryptos right now. Well, the Financial Times is reporting that Elliott Management has built a large stake in Barrick Mining. Elliott Management is a U.S. firm that is known as an activist investor. Let's bring in Alan Small, the senior investment advisor at the Alan Small Financial Group with IA Private Wealth. And Alan, speculation the company could be planning, could be a push for a breakup of Barrick.
Yeah, it's so interesting, right? So they're obviously North American facilities, their business in North America are doing a lot better than some of their other places in areas like Africa and other areas. So perhaps Elliott Management will come in and maybe push for something like that. Whenever you have an activist investor coming in, they're going to demand or ask for certain things. Usually it has a positive effect on the stock. A lot of investors like when someone comes in, takes a big stake in a company, and then tries to get people on the board and push for change. We're seeing that with, I guess, the stock price this morning. So not surprised to see that, and we'll see what happens. Barrick hasn't really participated, at least the share price has not participated in the run-up in gold as much as other names like an Eagle or a Kinross or anything like that. So I guess, trying to do what they can, and activist investors look for these types of businesses to get involved in, maybe a turnaround story and help push their agenda. So we'll see what happens.
And we've seen a few moves from U.S. companies, U.S. government, Trilogy Metals, they're involved with them now. Lithium America's 5% share in that. New Gold, of course, bought by Core Mining. Is this part of that? Could we see Barrick end up south of the border?
It's tough to say. I think a lot of the push that the government, U.S. government, has made is into more of the rare earths, the energy, things that they, look at as to say, you know what, we don't want to have to depend on anybody else if something bad should happen. If we're in a case of war or a case of a situation where, they don't want to have to depend on China to send over the rare earth materials. So that's a big one, right? Them taking a stake in MP Materials and other companies like that, taking stake in uranium companies for nuclear energy and things like that. Not sure about a name like Barrick. I don't see that as being on the radar for them. And, I think they also have to be leery of the fact that if they go in and buy too many of these businesses, people are going to start to ask questions. Is this, what happened to capitalism? Are you now just taking over everything? And what makes you different than what they're doing in other countries, communist countries? So I think they have to be careful when doing what they're doing. But yes, of course, I think security, safety, being able to be self-sufficient, definitely important, And I think that's why President Trump has said lots of times why he's been putting tariffs on things such as pharmaceuticals, right? During COVID, they had to rely on many countries for equipment and for drugs, whereas if the U.S. was more self-sufficient, they would need to be dependent on these countries. So I think that is what the president is saying and why he has done a lot of the things he's done.
And then, but with something like New Gold being bought by Core Mining, could you see a push with Barrick from that side, a company coming in and trying to bring it south of the border?
Yeah, absolutely. I think there are always opportunities. Obviously, right now, gold being as expensive as it is, a name like Barrick trying to do what they can because they haven't, as I've said, they haven't shared in the run-up as much as other companies. And so, I think, again, that's another question for me for an activist investor coming in, and if they are taking a very large stake, what changes are they going to push for? What changes are they going to recommend? And I think if you're an investor sitting with shares right now, you're probably happy that this is happening.
And are there dangers to it, to American companies coming in and pushing for that?
I think there are. Companies, American companies trying to come up here and buy companies in Canada. We look at the TSX right now. Once upon a time, when I first started in this business, it was the TSX 300. Now you're looking at 210 stocks that trade roughly on the TSX. So, you kind of lose our identity a little bit, in my opinion. I think you're starting to see companies disappear, whether they're getting bought up whether they're just no longer viable. I think that is a concern, in my opinion, for us here in Canada. I think you want to see more business rather than less businesses. So more businesses going public versus companies being bought out by companies down south. So yeah, I think it can be a concern. And I think the government has to look very carefully at letting some of these acquisitions go through.
Okay. On that note, we'll leave it there. And coming up, though, we'll be talking a little bit more about who are on the radar, what's on the radar, I should say, for Alan, and then what's on his radar. That's coming up after the break. Time to see what's on the radar for Alan Small. He's the Senior Investment Advisor at the Alan Small Financial Group with IA Private Wealth. And Alan, I think NVIDIA. Everybody's radar.
Everybody's
bing,
radar.
Bing, bing.
Exactly. Everybody's radar. Obviously, the biggest company in the world makes up almost 10% of the S&P 500. A lot of people, just with that alone, are talking about, is NVIDIA the leader of the bubble, so to speak? And I don't think so. I don't believe that is the case. You know, you hear many people speak. You're still hearing that we're still in early innings of the AI boom. If that is the case, how can you believe that NVIDIA is expensive? Actually, if you look on a forward earnings basis, trading in and around 30 times, growing 50%. So I don't believe in this bubble talk. I think that, yes, there are certain companies that perhaps are inflated in value, because the tech talk has lifted all boats, if you will. But for me, yeah, NVIDIA earnings, it could put to rest, at least for the time being, all this fear about companies getting over their skis, borrowing money, growing too fast. Is AI actually doing what it's supposed to be doing? Are companies just spending out of control? You know, the companies like the hyperscalers, the Metas, the Microsofts, the Amazons. So it's going to, I think NVIDIA, we've all been talking about it probably for weeks. It's now come down to what, 24 hours, a little more from now.
There's a countdown clock going somewhere,
is counting
right?
down, exactly. We'll hear, not only what they've done this last quarter, but I think when the CEO, Jensen Huang, starts to speak, it's more what is coming down the pipe, their next set of chips. And everybody and every company that has anything to do with NVIDIA, business with NVIDIA, buying their chips, anything to do with data center and AI, I think they're all going to be affected in some way come, I guess, 4:30 tomorrow afternoon.
And what are some of the numbers you'll be looking at that'll matter the most to you?
I think to me, it's not so much the numbers, as I said, of this past quarter, although they're obviously important, but what's the outlook? What is Jensen Huang going to say about the outlook for NVIDIA chips? Is the boom still in its early innings? He's going to probably say yes.
Of course.
We've heard many other CEOs say yes. We want to know, are they selling chips? We're also hearing that demand is so strong, they just cannot keep up. Energy cannot keep up. The demands for energy for these, for AI, for data center, cannot keep up. And so, again, that is another fear. But it's funny.
But those aren't necessarily bad problems. You don't want them, but they're not bad problems.
No, but it's interesting because if NVIDIA says a very strong story that demand is off the charts, well, I think the market could be a little spooked by that because maybe they're going to say these businesses are just spending like drunken sailors. They just keep spending, and that may not make sense. On the other side, if NVIDIA says things are slowing down, that's not going to be good. Because for obvious reasons, that maybe we're at peak spend at this point in time in the AI story. So maybe a Goldilocks scenario, maybe not too hot, not too cold, just right. Everything is right on track. We're doing really well. The growth numbers are there, but they're not over the top. Maybe that works. It's hard to say. You kind of have to hit that down the middle sort of thing. So it's going to be difficult, and we'll have to see what the market does initially. And as we know, usually that first reaction to numbers is usually not the right reaction. Yeah. You got to take a step back, hear the conference call, see where markets open up the following day, and then that will give us some indication as what's going on.
Yeah, there is a few hours to digest that all. I just want to ask about, what do you think of Amazon? Just put out a bond sale, first one since 2022. It just comes on the heels of a few other bond sales from the tech companies. Does that have people spooked too? Are they looking and going, "Where's their money?"
Absolutely. The spending is the part that's spooking investors. And what I say is, when you look at companies like Amazon or an Alphabet or even a Meta, the cash flow in these free cash flow in these companies is just ridiculous. And so, do you really have to worry when these companies go out and borrow? We've heard even Apple borrowing money over the years to fund some of their business because money was tied up in other jurisdictions, et cetera. So those kinds of companies, in my opinion, I don't think the market has to worry. It's the other types of companies, the OpenAIs, right? The private companies. OpenAI comes out and makes deals with Oracle and AMD and a whole bunch of others. Do they have enough money to be able to fund these projects? That is where I think that's ground zero for the nervousness. And we've seen a company like Oracle drop like 35% from that day where I think their stock went up 35% in one day.
Yep. They've
given back all those gains and then some. So the spend is definitely where the fear is going forward in tech land, if you will, in AI. And I think we need to gain some comfort that these companies do know what they're doing. I trust that they do, especially the hyperscalers. These are the biggest and best companies in the world. I'm not concerned with those names. The concern, I think, is more with the others, the smaller companies that if they are borrowing to spend on tech, on AI, data center, et cetera, on the chips, is it worth their while? Are they getting return for their spend? That is the question.
Okay, we'll leave it on that note there. We're coming up after the break. We'll be joined by the author of a book highlighting one of Canada's prominent billionaires. That's next. David Thomas joins us. And of course, our phone lines will open soon for our first call segment, 1-855-326-6266, or you can send us an email at firstcall@bellmedia.ca. Prime Minister Mark Carney winning a narrow vote to pass the Liberal budget last night. The minority government got 2 votes that put them over the top. Most abstained to allow it to happen, and they also got support, of course, from Green Party leader Elizabeth May. Carney promising May the Liberals would abide by the Paris Agreement target on carbon emissions to get her backing. The new budget looks to put tens of billions of dollars in trade infrastructure, defense, and housing. That's where the money will be spent. Okay, shares of Home Depot falling in the pre-market, off by 3.53% right now. The world's largest home improvement retailer cut its full-year earnings guidance. And the company says ongoing consumer uncertainty and continued pressure on housing are affecting demand. Home Depot also reported lower than expected profit and sales, citing a lack of storms, and that hampered demand for roofing, generators, and the like. Shares of Cloudflare are falling in the pre-market, off by 3.52%. This after the software company experienced a widespread worldwide networking outage. Websites including ChatGPT and the social media platform X were affected. The company website said it had been experiencing issues with a customer service portal and was scheduled for maintenance in some areas. Cloudflare's system, has gone down repeatedly before. And a quick look at the markets, all trending down on the futures right now. Dow off by 0.75, NASDAQ down by 0.56, and the S&P 500 off by 0.45. The founder of Fairfax Financial is Prem Watsa, an Indian-Canadian billionaire businessman, and his success story was reflected in a new book that highlights the story as he built a $45 billion global company from just $8 in his pocket. Not a bad ROI. Let's get more on this from the author himself. We're joined by David Thomas, author of The Fairfax Way. David, thanks very much for joining us. I'm just going to show the book here while we do this.
Morning.
There it is, right there. Get it there in the light. There you go.
Book released today, yeah.
I guess to say impressive is an understatement.
Of the book, have you read it already?
I had it. No, I had it. I had a chance. I looked through it. I didn't read all the chapters, but the book is magnificent, Shakespearean.
Yeah, I mean, you look. I think a couple of numbers tell the story. They've been running for, in fact, they just celebrated their 40th year last month as a public company. But if you look at the numbers just to the end of December, we're looking at, 21% compound annual return. The comparables are 11 and change for the S&P and about 8% for the Canadian market. So yeah, impressive is a good word.
And he's still going strong. Now, in the book, he's called a combination Warren Buffett and Howard Hughes. That is quite the combination.
When I started it, I thought I was going to sort of rule out that misconception, because a lot of people called him the Warren Buffett of Canada. I don't think he really loves it because he's not trying to be anybody other than himself. But the model is there in terms of building a holding company for the long term in a decentralized way with a big engine of it is insurance companies on one side. They have float. So they take money in and they hold on to it because they have to pay out returns. But hopefully they won't have to pay them all out. But more importantly, over time, as they hold on to that money, if you're a good investor and not just sitting in 2%, if you're smart and can make good bets, you can make a lot of extra money. You're basically getting free leverage. So that's the model where you look at Warren Buffett. Prem had a really good record calling the market. Warren's obviously got a great record. And so there are similarities, but Prem's model is global. Warren always stuck to the U.S. Much more diversified for Fairfax. So there are some similarities and some big differences.
I guess Prem Watts obviously a big name. During my career, there were also times where some controversy, right? Like his name was in the media for some controversial times and some questions. How was that? I guess you touched on that in the book as well, I assume.
Yeah, there's a couple of things. So there's always this gap between if people even know them at all, and do people pay that much attention to an insurance holding company anyway? It's not the sexiest sector, but for a long time they were golden. They were the market darling. This is the 1990s. They were buying companies. They were building up, and I think people didn't understand it because suddenly at the end of the 90s, they pretty much stopped. They made a couple of more acquisitions, but they had done their building, and then they needed to fix and polish those assets and then grow organically, which is a lot cheaper. It's a smarter way to do it, but they had to buy those companies first. But I think a lot of people, a couple of things went wrong. So in terms of how they went from the market darling to a bit of a pariah was those assets that they bought. A lot of them weren't in great shape. So they were buying insurers using a value mindset where they bought companies that were cheap, but for a reason, right? And I think they underestimated how long a lot of those companies could backfire. When you have, you buy these companies, but they've got all these policies that they've written in the past, and if there's a toxic long tail potentially, and things like asbestos and a lot of other things. So what happens is they might be generating cash, but they're under reserved, and every year you have to shovel a huge pile of your earnings into these companies, and they become a real drain. And you can never do it unless you're going to write stuff off. And Prem never wanted to write companies off. He didn't want to lay people off. He was in it for the long term, and he wanted to fix them, but they took a long, long time to fix. So I think what you're talking about is, people losing interest, right, a little bit in the 2010s, but there's a lot of good things that happened. They made some market calls that were outstanding. He was really smart at making some bearish calls. The Big Short, they made out probably better than anyone. But they stayed, here's another thing, just sort of going past into the 2010s, is they stayed bearish. So you had a period post financial crash where we were entering deflation. The aftershocks were killing the economy. You saw quantitative easing, and as well as qualitative. Interest rates were down to zero. It was a really tough environment, and they were worried about their capital. So they started shorting the market again, and it paid off in spades in the 2000 tech wreck. It paid off again with the great financial crisis. But the disaster never came. The central banks really bailed things out. And meanwhile, they spent a fortune. They lost billions of dollars over a number of years paying for all those hedges and shorts, and the disaster never came. So they decided there's a smarter way. They kind of gave up on just raw bets, and they started investing in themselves, more.
I just want to get in one last quick question. One of the things I did have a chance to read through the book, like brushing through, but one of the things that struck me, I think he owned his mistakes a lot. It feels like when something went wrong, he said he laid it out. How important was that for his success?
Well, that was just the way he wanted to operate from the get-go. And I think if you take the time to read the letter, which started at a page and now runs up into the 30s, it's one of the best letters out there, along with Warren Buffett's. And the first thing they do is explain in detail all the things that went wrong. So, there was never an attempt to sort of polish it over.
Okay. David, thank you very much for joining us today.
Thank you.
All right. David Thomas is the author of The Fairfax Way about Prem Watsa. Still ahead, we'll look at why Build-A-Bear has been on an NVIDIA-like run. Also, our phone lines are open. Alan Small's taking your questions on stocks. Call us at 1-855-326-6266, or you can email us, first call at bellmedia.ca. Build-A-Bear CEO Sharon Price John has transformed the iconic mall-based toy retailer into a multi-platform brand, from a struggling stuffed animal store to a thriving intellectual property company. In this report from Bloomberg, Price John shares the leadership strategies and creative vision that helped Build-A-Bear's stock soar over the past 5 years.
The actual experience of building a bear can be equated to what it takes to be successful in business. You're picking something that you really like, you're stuffing it with the exact things that you need, and then you're willing to put your heart into it, you're going to increase your level of success for sure. My name is Sharon Price John, and I'm the president and CEO of Build-A-Bear Workshop. First, you get to choose your unstuffed furry friend. I really work very hard to assure that I have people on the team that are the best in their business. Now, we're going through a lot of changes right now. We're growing really, really fast. Any suggestions, any thoughts about what we can do? We try to create a really collaborative experience. We give the team an ability to bring forward ideas independently of what, we think is next. So I had a golden retriever. Her name was Katie, so I'm going to build Katie today.
I love that.
The next step is to put all the goodies inside. We went through a process of pivoting the company from what was a mall-based retail stuffed animal store for kids to a branded intellectual property company that just happened to have vertical retail as one of its revenue streams. When you can monetize a feeling, that's a much more diversified approach, and that creates a much more resilient approach to business. Build-A-Bear is a pioneer in experiential retail, so we were doing that back in 1997, and really there isn't anyone that does exactly what we do.
Rub it on your heart so she's full of love. On your head so she's full of your fun memories with Katie. And on your shoulders so you always have her to lean on when you miss her.
Give it a big kiss. And we have to put that inside so we always
There's
feel we love her.
a magical moment with this where in the mind of a child, the stuffed animal almost comes to life.
Good job.
Say thank you.
call it a bear market on a bull run. One of the best performers in the stock market this year, rising over 50% since the beginning of the year.
The consistency on the quarter-on-quarter deliverables, we've been not only consistent from a business perspective, but we've kept a very clean balance sheet. We have tremendous cash flow.
For those who would compare it to like a meme stock, how is Build-A-Bear different?
Our stock appreciation is based on the fundamentals. If you just break down what we've been able to do from an increase in profitability, it starts to add up.
How have tariffs and supply chain shifts affected your gross margins?
Tariffs are a challenge for any company that's importing, and we've diversified our supply chain significantly, but that still does not keep us unimpacted by tariffs. We're going to have to cover some of these costs. We will not be able to cover it all, and we won't pass it all on to the consumer, but there'll be a balance.
What is your read on consumer discretionary spending on the current economy?
We are not recession-proof, but toys are often very recession-resilient, particularly during the holidays.
There you go. Thank you.
And when you think about how we're kind of in this crosshairs of the nostalgia economy, there's kidulting, DIY, and we're sort of mashing a lot of that stuff together.
We actually doubled the teen and adult business to be 40% of the total sales.
And I'm hoping that we'll be able to enjoy that trend for a while. The secret sauce of Build-A-Bear's success thus far is that we believe in what we do, and we believe that what we do matters. If you can recognize that it's probably going to be a long game and you have your heart in what you're doing, you're really increasing your odds.
Still ahead, Canada's annual inflation rate, I love that, was 2.2% in October. Take a closer look at the costs Canadians will face after the break. According to Stats Canada, our annual inflation rate was 2.2% in October. For a closer look at the costs Canadians will face after the report showed that inflation cooled down last month, CTV's John Venavalley-Rao files this report.
While the price of gas is still higher than many drivers would like, StatsCan says the cost for that fill-up has been coming down, with prices falling more than 9% compared to a year ago and 4% in the last month. In part as motorists switch to less expensive winter gas blends, along with another big factor.
This is still being affected by the removal of the carbon tax earlier this year.
And at the grocery store, prices also coming down, falling more than 0.5% from September to October, the biggest monthly drop since 2020. While year over year, prices are still up 3.4%.
Maybe I've seen some small relief in some areas, but still generally higher than they have been.
A lot of things are definitely still pretty expensive. Some things are definitely a thorn in my side, like the price of beef, for example.
The 1 month fall attributed in part to the elimination of many counter tariffs on U.S. products.
The food inflation rate dropped, which is certainly good news, and we were expecting it, to be honest. There's less pressure at the border. Counter tariffs are gone now since September 1st, and it's helping. It's helping.
It's all contributing to overall inflation coming in at 2.2% in October, down from the previous month, though notably some items getting a lot more expensive. Cell phone plan prices rising around 7% year over year, as did home and mortgage insurance and car insurance.
When we talk about stickiness of underlying inflation, insurance is really a big issue, and it's a big issue right across Canada. And I'm sure most homeowners and vehicle owners are really feeling this.
Rent also up 5% year over year. Meanwhile, the numbers released today has economists now betting the Bank of Canada will hold interest rates steady for the rest of the year. John Venavalley-Rao, CTV News, Toronto.
The Canadian Real Estate Association says the number of residential properties that changed hands in October was lower compared to a year ago. Prices, though, also fell. CTV's Adrian Goldborough with the latest.
I've been struggling, basically making income.
Mariam Mousavi admits she's been struggling financially as a full-time real estate agent in the Greater Toronto Area. Her net income has dropped significantly since home sales in her region began to plummet.
200 to 300K versus for past year, I think I didn't make more than 50K.
A single mother, she was forced to list her own home in April. 7 months later, it hasn't sold.
I have to basically beg people to come and just even look at the house.
The national average sale price of a home sold in October was just over $690,000, down 1.1% from a year ago, according to the Canadian Real Estate Association.
If you're in Quebec or you're in Saskatchewan or you're in Atlantic, you're in good shape. If you're in Ontario or British Columbia or maybe even Calgary, you got some issues.
This home east of Toronto was purchased in September 2024 for $2.3 million. Last month, it sold for $1.2 million. The seven-figure loss is the result of a power of sale.
Power of sales are way up in the GTA. They're up 90% compared with what they were just a few months ago.
Losing the homes to the banks is a real possibility that has led to sleepless nights for Musavi.
I've never seen anything like this before. With no income, I couldn't even pay my mortgage, and I have to sell the house.
The Canadian Real Estate Association expects the housing market to become more active in 2026, though some experts we spoke with say the economic uncertainty could prolong the pain for many. Adrian Gobro, CTV News, Newmarket, Ontario.
When we come back, Alan Small will take your questions on First Call. All right, time to go to the phones for our first call, and our first email comes from Amato. And Amato says, good morning. My question is on Visa. Is it a buy here?
Good question. You know, Visa is I say good question because Visa is one of those steady as she goes, right?
Yeah.
It always seems to move higher, trades in at around 30 times forward earnings. So it's never really cheap. As you can see, it's been a bit of a trading range and slightly going to the downside, obviously. Visa is interesting in that they are moving into the future with things such as stable coins and artificial intelligence. They are saying that the world ahead is going to be a lot different from a payments perspective than the world we've seen, that it's not going to be necessarily just plastic. And so that's really interesting. And a company like that, you like to be a part of, you like to own. So I would say on a pullback, yeah, I think Visa is a good company to own. I'm not so sure I'd be buying it today. But I think if Visa can pull back a little bit from here, be a little bit cheaper, it's a name that I would take a look at going forward for sure.
Okay, let's head to the phones. And Sam from Ottawa, what's your question?
Yeah, hi, good morning. Thank you for taking my call. My question regarding Brookfield Renewable Partners. They just announced a bought deal about a week ago for $29.9 USD, $650 million they're going to be spending on solar, at a carbon, and then 200 million of that is from Brookfield. So anyway, so we went in a lot recently, and we're still buying. What's your opinion on Brookfield Renewable Partners, especially since Mr. Carney, got his budget approved? Thank you for your time. Appreciate it.
Yeah, again, I think a good name. I like it. The dividend yield is good as well. It's in that area, like you said, Mr. Carney, trying to these big projects, energy. I think it's a name to look at. I've owned it in the past. I like the dividend yield probably more so than for a growth type name. Obviously, if you're looking at growth, you're looking at other areas of the market perhaps. But I think this name for a good dividend yield and some growth over time, so maybe a little bit of growth, a lot of income and a little bit of growth, I think it's a name that can fit as in part of a nice diverse portfolio.
Okay, let's get in a couple more if we can. Next one's an email from Zoe, and she says, can I please get your POV on Dell?
Another name. It's one of those mornings where I like a lot of these names. Dell, a great name, trading at under 13 times forward earnings right now. You can see here on the chart, it's come down. There was actually a downgrade of the name yesterday. Probably the only firm, Morgan Stanley, that downgraded. Everybody else has it as a buy. They went to actually a double downgrade from a strong buy to a hold. So, it's a name that I think is great. Obviously, artificial intelligence, big part of what they're doing. Servers, storage. You can see there, just fallen off quite a bit. Them, HP yesterday fell off by quite a bit. But I think it's a name you can get behind. Whenever you see Jensen Huang and NVIDIA, you see Michael Dell in the front row when he's giving those speeches. So I think Michael Dell is a very big part, and NVIDIA's chips, big part of what they're doing at Dell. I think it's a good growth name that you could buy today for very cheap, under 13 times forward earnings. And I think it's going to be a winner going forward for sure.
Okay. And we're going to sneak in another email, and it's from Bruce. And the question for Alan is thoughts on Blackstone.
Blackstone, another name I like. So we're batting 100 here today.
Perfect day for you today.
There you go. Blackstone, obviously one of the largest asset managers in the world. Have a lot of real estate business benefiting from the build out and from real estate with respect to you need property, you need places to put your data centers, and we're hearing from them. I saw an interview with the CFO not too long ago when they came out with earnings. Earnings were strong. It doesn't pay a big dividend, so you're buying this name for growth. It trades well off its high, right? You're looking at a pretty big, large decline from the highs. So I think this could be in the category of a fallen angel, a name that is very good, very strong, and I think on a rebound, look for a rebound in this name. And I think you can get into this name at these prices today.
Okay. We'll leave it on that note there. Alan, thanks as always for joining us.
Thank you.
It's Alan Small with us here on The Street. Thank you for joining us. And he's up next with the Open. The markets will open in a little more than 30 minutes. Have a great day.